This should work.
Oh, I think we're live. Okay. Hello, everyone. Welcome to Stock Talk episode 18. As many of you know, Daniel is actually in Asia. There's a 12-hour time difference. So, as we've mentioned, it's going to be a bit choppy when we're going live, but you can always watch the recordings on the Stock Unlock YouTube channel. Have to ask you, Daniel, any fun stories from Asia? I mean, I see a really beautiful shirt with some elephants on there. I mean, this is exactly what I expected, to tell you the truth.
So we're at the Airbnb right now. I'm with Shelby, my girlfriend, and so I don't get the best Wi-Fi from our Airbnb. It's like a little village of 5 huts, and there's like a common area where the Wi-Fi is pretty good. So I was gonna go over to the common area, but all the lights are out. So I'm streaming from our little hut, and I'm hotspotting the stream off of my phone right now. So we're gonna see if it works. It might cut out. I don't know.
For someone that has listened to a lot of your content and spent a lot of time on video with you, I do believe I've gotten accustomed to hearing you through a mic. And honestly, your regular voice too without mic sounds very beautiful, but definitely Daniel and Asia vibes for sure. Not the typical.
Dude, my mom's tuning in. What's up, Mom? How you doing?
Oh. Hi, Mom. Not my mom, but great to meet you in the chat.
My mom's on the stream. Yeah, so we're in Asia. We're currently in a town called Chiang Rai, Thailand. It's 8:35 p.m. for me, so it's a total 12-hour difference from you, Jake. And yeah, man, we spent the whole day exploring. We rented a scooter, and we were scooting around, looking at a bunch of different temples today. It was beautiful, and also driving scooters in Thailand is wild. So yeah, it was a good time.
Any funny stories before we get into it?
I don't think so. It was just like wild. But yeah.
Amazing. Well, here's what you could all expect today. Also, hello, everyone in the chat. It's great to see you there. I know this is a little bit earlier than normal, so appreciate you waking up with us or going to bed with us if you're in the other side of the world. So going to talk about Netflix earnings. Those came out. Daniel and I both took a look at them, and we have comments. We have not spoken to each other about it yet, so it's going to be interesting to interplay there and see how we feel. Microsoft also had layoffs. I just heard that from Daniel actually that Google announced layoffs, which is pretty huge. Taking words out of Daniel's mouth, one of the last big tech companies to announce, so that's big. And of course, we're going to go into stock talk. Daniel's bought a few stocks this week, and I never sell. I sold part of a position, one that I don't really talk about. So we're going to get into that later. Yeah. Daniel's about to faint because I make jokes a lot about not being able to sell. Anyways, Netflix earnings.
Broke your diamond hands, man. What the heck happened?
They're feeling a little weak, but it'll make sense when you get there. So a little cliffhanger, but would love to talk about Netflix earnings.
Yeah, let's do it.
Let's go.
Let's just dive right into it. So I'm going to have to figure out how to do this on my computer. So excuse me for a moment. First time streaming from a laptop. Starting off great. Live stream. There we go. Okay. Now I just need to share my screen.
Perfect. I didn't notice that your shirt is a Stock Unlock blue also. So
yeah,
good color coordination on our part.
Definitely made sure the shirt was blue. We'll talk about that later. Okay. I have this. So this is Netflix's income statement, if it's going to load here for us. Yes. So right here, can you see my screen, Jake?
I'm just laughing because from what you've highlighted, I noticed the same things. But yeah, please walk us through some of this. And it's a very interesting earnings report.
Yes. Okay. So we can see right here, this is their year end, December 31st, 2022. Revenue was actually down quarter over quarter, and year over year, I believe it grew by like less than 2%. So basically revenue isn't really growing for Netflix. We can also see that their marketing spend was at an all-time high in the fourth quarter, which is interesting because, they're spending a record amount of money on marketing, but their revenue dropped this quarter. So I don't love to see those two numbers. And then we can also see their operating income right here for the full year of 2022 actually declined by roughly I want to say like 8%. And then finally, we can see the net income here was 4.5 billion for the year versus 5.1 billion last year. So net income is also down. So basically, revenue year over year grew by like 1.6%, quarter over quarter it dropped. Expenses are up, operating income is down, and net income is down. So right away on the income statement, I don't think this was like the best report in my opinion.
I was not impressed either. And I noticed that too, that they had a record amount on marketing spend. People are a bit bullish on, oh, look, they kind of added subscribers. But here's what management also said. I read through the entire 22-page earnings release. They are going to start cracking down on account sharing. They expect that to have short-term lack of growth, the people canceling actually. And they also claim that that will give them more long-term headwinds on their revenue. They're trying to diversify their business a bit out of just video streaming. They're trying gaming, potentially looking into short form, things like that, and also highlighting, oh, like X% of people watch TV across these nations, just like around 10%, pretty low. And like, we're going to like bump that up. I'm also a little bit skeptical on that since I think a lot of eyeballs are going to short form, but I was just not super impressed with their future outlook. I also don't think this company really has a moat. I mean, obviously, tons of competitors are coming in with other video streaming services and spending a ton on content. I know Amazon's in there as well. So there's nothing really exciting for me here. I don't know if you saw how much debt this company has.
Yeah, I mean, they got $14 billion of debt. It actually went down year over year. And personally, I don't think 14 billion is too much of an issue for Netflix.
I don't think it's an issue, but it also doesn't get me excited. I mean, they had like several billion cash on hand. Their free cash flow was around 330 million for the quarter. Here's
Yeah.
some math I did on their market cap. At market close yesterday, their market cap was around 150 billion. If you forward projected that free cash flow onto their market cap, they are still trading over 100 price to free cash flow. Management
Yeah.
actually did project they were going to do $3 billion of free cash flow for 2023, even though they tend to not meet their guidance. From what I could see, they missed guidance on EPS as well. And even on the 3 billion revenue on today's market cap, if the stock didn't move at all in terms of value, that's still trading at 46. I think they're at about 150 before the report. So as we like to say, valuations matter. And sure, maybe they have a cool product, but wow, this stock just seems expensive to me. And they, like you said, they're not growing that much.
Yeah, I agree with you. I think the stock is expensive. Now, what's also interesting is for the full year of 2022, Netflix generated about $2 billion in operating cash flow right here, right?
Mm-hmm.
Now, remember on the income statement, we saw they generated about 4.5 billion of net income. So the
Yeah.
net income is more than double the operating cash flow. And you can see that this is mostly because they report additions to their content assets as net income. So basically, whenever they make a new show, they put that on their balance sheet as a content asset. So their assets increase, which causes their net income to increase. And then on the cash flow statement, they remove that expense because it's a non-cash, or sorry, that non-cash gain to net income. So their actual cash flow is less than half of what their net income is. So a large portion of their net income is non-cash gains. And then exactly as you said, they did about 1.6 billion in free cash flow this year. Next year they're projecting 3 billion in free cash flow, which would be a forward price to free cash flow of 46 for a business that is growing revenue by about 2% year over year. It looks very expensive to me. I don't get
Yeah.
it.
Yeah. Nothing really got me too excited about this. And in the shareholder letter, they talked a lot about their product. And, you know, we both like to think about it as the business, right? So they
Yeah.
introduced this ad supported tier. There was a lot of controversy around it, basically a lower price tier that also has ads in it. One thing I did actually like about this is they made a comment in the shareholder letter that this pricing tier could potentially give them more money net than the non-ad based tier over time, not today, obviously, because they are selling ads. So a lot of the narrative was pushing that they're building out their ads business more. They're going to really start trying to get more income from that. And again, long-term tailwinds that they forecast on getting more revenue through charging an additional fee. I don't understand the costing structure perfectly on the account sharing. So they've been gearing up for that for a while. I am super interested to see if all these people who are mooching off of Netflix subscriptions will actually stay, right? Because I have tons of friends. Yeah, I have my mom's account. I have this. And I ask them, will you pay for this? I ask these people when I'm out, I'm like, will you pay for this?
No,
And everyone says no. So
it's funny because I just looked over at Shelby and she was like,
will Shelby pay for Netflix if they make her cancel? I'm curious.
I would not pay for Netflix.
She would not.
Couldn't mooch off people.
She says no. If she could not mooch off people, she would not pay for Netflix. So there you go.
We had a very funny commenter in the comment section on the last stream after we posted saying, after we explicitly said, don't invest in our opinions, they said, I invest off of Jake and Daniel's girlfriend's opinions when they get asked on the show, do you buy this beauty product? Would you buy this stock? So not a suggestion to do that, but
that person's selling Netflix right now as fast as they can.
And look, let's be a bit respectful to them, right? They were kind of first to the game in creating these products. This is no joke of a business, right? Like the numbers that they pull in their revenue and everything are very great. I also try to put myself in the shoes of someone who works there as an engineer, started off, the CEO's leaving, like you used to be very innovative. Now they're changing a lot of the company just to work on ad structure, and all of that. It's just,
you want to know,
here's
what I do. All right. Especially now that I'm in Asia and I'm not streaming that much, I will pay for Disney Plus. If a show comes out, I'll watch the show, I'll binge it, and then I stop paying. I do that for Paramount Plus, all these different streaming networks, because there's so many now. As soon as the show comes out, I buy the subscription for a month, binge watch, and then I get rid of it. So that's what I mean is I'm just not confident in these businesses long term. And there's so many more popping up all the time.
Exactly. Lack of moat is, I think, the perfect term here. They have hit shows. They're good. I also don't think Netflix is going anywhere. But again, we like to invest in growing businesses that have big moats. And seeing all the encroaching competition to me here just gets me really nervous as an investor. I don't see them being able to continue to raise prices while everyone else is offering somewhat similar services and trying to price cut them.
I don't think Netflix is going anywhere. But if they do, I hope they can just finish The Witcher first, because that's a sweet show. And I just want to see it end, Anyways, I think that's enough of Netflix.
Yeah. So there's a lot of layoff news going on. Microsoft announced layoffs about 5% of their workforce. It seems that Google has done the same today. When will the pain end?
So Google finally announced their layoffs. I remember everyone was talking about how, Google is the last company to start laying off, or the last tech company, to start laying off people. And it sounds like they're laying off 6% of their workforce now, 12,000 people. And what's funny to me, it sucks people are losing their job, but the market is funny because Google stock is up 3.5% before the market opens right now on news that they're laying people off. So right now, layoffs equal a good thing in the market. So if you lay people off, your stock goes up.
This is a hard one to talk about because these are real people losing their jobs. But as a Google shareholder, I believe you are one as well. This is also a bullish sign for me. It comes down to obviously cutting costs. They become more profitable and they are able to focus then, at least what Microsoft said in their letter. They're like, we're cutting our workforce, but we are still hiring strategic areas. So it's shuffling things around. My heart does go out to people who got laid off. I do believe these companies handle this very well in terms of severance and making sure that these people somewhat land on their feet. But it is hard to forget that, some lives get disrupted from this, and it is hard to balance. But I do take emotions out of investing when I can because, it is to make money, and you hope that you could use that capital in the future to help sell things like this. So a weird balance going on. How do you?
This is what Google does. As a shareholder, they were probably being way too frothy with hiring people over the past couple of years. So, in terms of business sense, I think it makes the most sense to start laying people off. What was I going to say? Oh, Google did this in 2008 as well. They started focusing back on profitability because what happens when the economy is expanding and everything is fine, right? What happens is businesses just spend more and more money on growth, and they get a little bit more frothy with how they spend money. They don't really focus that much on okay, where is actually the best spend? It's just kind of like, let's throw money at everything and just try and grow. But then when the economy starts getting worse and starts contracting, then they're like, okay, well, now we can't just do that anymore. Like, we need to focus back on efficiency, profitability. So the best businesses, in my opinion, actually get stronger through a recession. And it's exactly what Google did in 2008. If you go back and look, I did a video on this. Google's net income and profits went up in 2008 because they cut back and focused on efficiency again. So as a shareholder, I want them to do that again, because I think they got a little bit, I think they need to cut off some fat now. And like, I think that's going to be in some layoffs. It's probably going to be in some other areas that they spend in the business, but I think it's what they got to do.
Yeah, it's a little bit of reset back to normal from COVID. I think there was a lot of overhiring, in my opinion, and over projecting of pre-hiring for great things to come. People got a little bit, as humans do, greedy, as some would say. But an interesting thing happening here, Microsoft and Google, I believe, are starting to battle it out. ChatGPT-3 is obviously the rave. We don't know if it's a fad or a trend. I think obviously AI is here to stay. And of course, Bing right now only has a couple percentage points in the search market. Google has always been floating at 90%, but I think around half of Google's income, or rather revenue, comes from advertising and search. And people and investors like myself, I'm investing in both companies. I'm watching this one closely because Microsoft announced that they're going to integrate ChatGPT-3 into their search infrastructure. On the back end of this, Microsoft also has the second biggest cloud, which is Azure. They're going to start to get a lot of spending on that. And everyone's looked at the capital structure of their investment in OpenAI. I believe that they will have a 49% stake in a large percentage of the profits and look to be investing another, I believe it's 14 billion. I'll have to fact check myself there. But they are making big moves. I'm a little nervous to see if it pays off. I know they'll be fine, but it's a huge bet to make. And it seems like they're getting both sides of this. Consumer input potentially on search and taking market share from Google, as well as additional spending and revenue that they'll get into their cloud services and ownership into what is now one of the best AI companies on the planet. Things are moving so fast. I'm not confident that will be the case in the future. I think it's hard for anyone to follow this. I'd love to get your thoughts on that, Daniel. Have you been following this one at all?
Not like super close. Google actually put out, they're going to be putting out blog posts over like the next month, I believe. And they're starting to basically address everything that Microsoft is doing. Like I believe in their most recent blog post, they said they're going to start integrating some sort of chat transformer like ChatGPT into their own search. And basically they're just like, yeah, we have this technology. They were saying that their technology is better than Microsoft's. And I guess they're going to start using it in more ways. So we're going to see how it plays out.
I think one last comment here is Google is a very mature company. They are very well versed in, legalities behind things and stuff like that. Whereas startups, move fast and break things. And I'll put Open AI in that category, separating them from Microsoft for a second. Google's been sitting on this stuff, and there's been a lot of legal attention on the data that gets fed into these AI algorithms and where it is sourced from, and if that is IP that people own, if people are infringing on digital rights. So if you train your data set on a bunch of Getty images, I forgot what company did this, there was actually watermarks being generated from AI products of other companies' IP. So obviously that's a very blatant example, but I think that there's going to be a lot of legal proceedings yet to come. Shout out to the This Week in Startups podcast from Jason Calacanis. They've been having a lot of really great conversations about this, which is where I'm getting a lot of my information from. And I think that there is a very long story ahead of us in terms of who gets the money here, how can you monetize these products, and just all the legality around AI training data sets. It's just a huge unknown. So I am closely watching this one as an investor. It's just watching, the dominoes kind of fall in front of me, basically, and trying to make the right moves.
Yeah, for me, it's like a wait and see thing. I don't know what's going to happen, but if it's going to be negative for Google, we'll see it in the numbers. So I'm just going to be paying attention to the reports that come out, and like, is it actually something to worry about? I have no idea. We'll see. I'm not going to. I'm just not going to speculate on what happens there. Like, I just have no idea. It's not the most sexy, exciting answer, but it's just like, I don't know. I don't think anyone knows. For me, it's just like a hold, wait, and see what happens.
Yeah, no, I agree. Guys, stay data driven. Keep your eyes on it for sure and watch it, but don't be a guru that can see into the future because that's probably not going to work out well for you.
Yeah, and like I don't know. Google's maintained their moat for, decades. No one's been able to touch them. Well, we're going to see if that changes, but we'll see, man. We'll see. They have a very strong moat.
Looks like we got a comment up here. I'm not sure if you clicked that one or if that was me misclicking.
That was you. I definitely did not click this one.
Well, it's up. It was an accidental click, but we'll answer this one quick because it's on the screen. We will start showing this in the first quarter of this year. Right now, our data provider does not break this down in their GAAP reported financials. We do show the net amount, which balances stock-based compensation with share buybacks, which is nice. So definitely expect big improvements there. We will be multi-API and taking the best from multiple API providers, which also de-risks our business. Stock Unlock. If you're not familiar, definitely check us out at stockunlock.com. We're building a lot of great software there. And Daniel, I think you and I have both made some moves in the market today. I sold a stock. You bought a few. How do you want to handle this one? You want to go first?
Yeah, we just have a question here. This person asks, do you think Jeremy from Financial Education is right that the stock market is going to crash?
We just said we shouldn't try to predict the future, right?
Yeah, I don't know. I don't know what's going to happen in the market. And the reality is no one knows what's going to happen in the market. So I'm just going to say, I don't know. If it does, then I'm going to buy some great businesses even cheaper. If it doesn't, then I'm going to continue buying. And I just don't know where the market's going to go. And I don't think Jeremy knows where the market's going to go. I don't think anyone does. That's my response. Fair. Okay. But what we have been buying, so this is going to be boring for me. I've been buying more BAM, which I'm sure does not surprise anyone. So basically, I funded my TFSA. I've maxed it out, the 6,500 that I was able to do for 2023. And then I put money into my RRSP. These are both tax deferred accounts. So basically the dividends that I make in these accounts, the dividends I receive in these accounts, they're not taxed. So I get the full dividend and then I can reinvest it, do whatever I want with it. So I max out my TFSA and my RRSP with dividend stocks. I think that BAM is the best dividend stock right now. I've said that on my channel. This is not financial advice. Do not go buy BAM. But personally, I think BAM is one of the most attractive dividend stocks in the market right now. So I bought a lot of BAM.
No surprise there. What about the other two stocks? I've heard a lot about BAM.
I'm sure everyone's heard a lot about BAM. It's a great stock. BAM. I'm not promoting this, by the way. It's just fun to say BAM. Don't buy it.
I mean, that's such a huge stock. It would be hard for us to move it anyway, but please do your own research. We are not financial advisors yes.
Absolutely.
Were you buying anything else this week?
Yeah, I bought TD Bank. I haven't bought TD Bank in a while, but I've been like dollar cost averaging other stocks so much that TD Bank got down to like a 2% position for me. And I was like, I like it. I don't think it's going to make, huge returns. I'm not expecting like 15. I'm not even expecting 10% from that one a year. But, on top of the dividend, 7 to 8% growth over my lifetime, I would expect per year. I just think it's a solid stock that you don't got to worry about. At least, I don't got to worry about. So I bought some more of TD, topped it up a bit. And then I bought some Go Easy, a little bit more. Added some to my Go Easy position. That's a subprime lender in Canada that's growing super well. I talked about them on my channel before as well, but basically I've just topped up some things that were getting low in my portfolio and more BAM.
Nice. I've been dollar cost averaging as well. A lot of people know that I'm an Airbnb bull. I started buying it when the stock went well below 100. Again, a slow dollar cost average in. Not going to go through my thesis there. It's been through it before. That stock has ran a lot, which actually pisses me off. It went back over $100 for a second there and then dropped back down, which is nice. As a long-term investor, I actually want those shares to get cheaper because I'm so bullish on the business long-term. I want a lower cost average. So I bought one share of that this week. I bought another share of Microsoft. Bought a handful of Google stock, honestly. I'm super bullish on that. I listened to the Lex Friedman podcast with Mr. Beast, and after watching and hearing all these creators and what they spend and invest on YouTube and their thoughts on it, YouTube's not going anywhere. It's only growing. People are ignoring that. Google Cloud is a monster. I actually expect Google's ad revenue to become less of a piece of a pie of their overall revenue stream, which I am fine with. And I think their business is diversified as heck. And I just love it. So continuing to dollar cost average into that. And Daniel, I might screen share for this one because I'd sold a stock. Sorry. Before that, any comment?
Yeah, really quick comment from me on Google. I think that Google is an AI company masquerading right now as what's that? An advertising company. I just think they're leading the world in AI in like almost every way. And I think that's going to become more and more important over the next decade. So we're going to see. I'm very bullish.
I will outbull you here and say I think their business is so big and diversified that I agree with you, but I also would say they're not just AI. Like YouTube is a social. They have a cloud infrastructure play. Yeah.
They're definitely not just AI, but like what I mean is AI powers everything. Like YouTube, for example, AI powers YouTube. AI powers search. AI powers the cloud. It powers, I believe they own DeepMind. And just like a bunch of these other projects, and as I said, over the next decade, I think AI is going to become more and more prevalent and more important for businesses.
Yeah, it looks like Go Chasing Waterfalls believes you there. It seems that Gustavo does not. I don't know if this is a serious comment, but shorting Google next week. I mean, hopefully that works out for you in the short term.
We got a nice comment here. Stock Auto says, "Great haircut, Daniel." Shelby, you hear that? This person says, "Great haircut, Daniel." No, it's a real comment.
Look at how relaxed Daniel looks. Yeah, it is 9 p.m. almost bedtime there in Asia, just to be very clear on the time difference. And I am just waking up in New York. Definitely not on 4 hours sleep. Hopefully you don't see the bags of eyes under here, but I will be taking a nap today, I promise.
Yeah, it's late here. We had a very busy day, so I'm a little bit sleepy. Anyways, let's continue on. I was actually shorting the Dow before Jeremy was, although based on his analysis. Shorting the Dow.
I'm just generally against shorting, and I'm not telling people that they shouldn't short. I think it's a great way to balance out the market, but as for me as a long-term investor, it just gets me a little nervous. I don't think I would sleep well at night. It's very hard to predict the short-term movements, and technically your losses could be unlimited. Obviously, there's ways to limit that, but best of luck. I mean, it seems like you've been making some money if you were shorting the market in the past year, honestly.
I mean, the Dow is made up of a lot of these consumer staple companies like Procter and Gamble or like Coca-Cola, which I do think are more on the expensive end right now, but I wouldn't, just me personally, I wouldn't go as far to short the Dow. Historically, it's been one of the most stable indexes with the lowest volatility. So I don't know. Shorting an index is, I don't know.
Quick plug here. Our newsletter, Stock Unlock newsletter, free to sign up. Go to stockunlock.com and you can enter your email right there. There will be a note on the Procter & Gamble stock, I believe, this week as a little sneak peek.
Yeah, I'm going to send out that newsletter right after the stream, by the way. So if you want our newsletter,
every week, a lot of free content there from Daniel himself. I subscribe to a lot of newsletters, and saying this, it is probably the best newsletter I've ever read. Maybe I'm a little biased, but honestly, man, I read Morning Brew, I read all these. I'm not saying the other ones aren't good, but wow, maybe about like a 5-minute read and always just like really well written content. So, hats off to you there.
Thank you, sir. All right, let's.
I still got the note on the stock I'm selling. No rush there, but
yes, let's do it. Yeah,
cool.
What are you selling? Because Jake is master diamond hands. He's like Charlie Munger, never sells. So I don't know if we can call you diamond hands anymore. We might have to downgrade you to like platinum hands or gold hands. But
I will fight you on stream. Okay, so AEM. A little bit of background here, Daniel. About 2 years ago, because I've been a viewer of your channel for a while, especially when COVID started to hit, you put out a video on Kirkland Lake Gold, The ticker used to be KL. They actually merged into this company. I did a lot of research on that company and will not run through the fun you have in learning how to analyze gold mines, Mikasa, all the different mines they had around the world, and analyzing the saturation of the ore that they try to get out of those mines. But it ended up being a large position in my portfolio. After the research I did, Daniel, I did put about a 9 to 10% stake in terms of diversification of my own portfolio into Kirkland Lake Gold. This is a stock that I've held for about 2 years. And, as the greats say, diversification is a hedge against uncertainty. And that hold was exactly this. I really like that they were a well-run gold mining company with all the uncertainty around COVID, fiat money, inflation. That just felt like a good hold. When it merged into AEM, I had about 194 shares. And I've just been holding them. I sold 100 shares of the stock this week. Not financial advice. Do not follow my trades. Consult a financial professional. And just very quickly, Daniel, the reason why I did this, and to be honest, it was kind of an off the bat decision. I'm still holding around half of it, but I wanted to take that money to put into stocks that I thought were lower priced. Their payout ratio is over 100%. So the dividend that they're paying is not covered by the free cash flow right now. I was not super impressed by the price of the company, and just looking at their growth and stuff after the merger, I feel fine holding it. I don't think they're going anywhere, and I still think it's a nice hedge. But looking at the size of this position in my portfolio relative to other positions in my portfolio, I just really didn't want to hold that much of it, especially, really focusing on the payout ratio and price to free cash flow right here. Also, the yields on the stock right now are kind of meh. It's below, the 10-year government bond the last time I checked. So if you have any thoughts there, Daniel, would love to hear. Would to hear critique on my sell here, and just want to highlight I do still own about 45% of my original position, and I did sell at about it was a 13-14% gain, since I did a tax loss harvest sell strategy where it sold my highest price shares first, which does also make my unrealized gain on my current shares look better, which is cool.
Yeah, so I don't hold any gold stocks anymore. I found that, well, it's basically a commodity stock. And as I've said on the streams before, I don't personally love commodity stocks because I don't know what the price of gold is going to do. And whatever the price of gold does changes how much profitability they have, changes their asset value. Basically, like, depending on what the price of gold does, the fundamentals of these businesses can change quite drastically, which makes them less predictable for me because I don't know what the price of gold is going to do. In 2020 and in 2021, I made videos on gold trying to predict what the price of gold was going to do, and I was flat out freaking wrong every time. So I don't know if it's predictable. I can't do it. So I just got out of it. You should not listen to me about my opinions on gold. I've been wrong. So
Yep.
I stopped trying.
Yeah, and just to be clear, separating out opinions here, I'd say the diversification hedge here, I think, is a solid thesis. I'm not trying to sell it, but in terms of having uncertainty about where currency is going, gold has always been a store of value. I agree with you. Short term, cannot predict the price of gold. A lot of people debate that it's highly manipulated by central banks and all that. We're not experts there, so not going to go into that. But
The thing,
I did like holding this, and a lot of these companies are pretty well run. I don't think gold's going anywhere. If you look at the governments that hold gold and the amount of it, it's still a huge, huge store of value in the world. So not much more we can say there other than that they are an interesting piece of your potential portfolio to look at. But like you said, Daniel, incredibly hard to price in the short term. So this for me was a hedge against uncertainty.
Yeah, like, Kirkland Lake Gold, for example, was one of the best performing stocks on the Canadian market for a long time. So it does depend on the management, like how effectively they can use cash flows to buy new mines at a discount and then like extract value from the mines. But in terms of just like investing in gold, I think stocks are a better investment. They've, over the past 100 years, performed incredibly better. I think gold has appreciated at something like 2 to 3% per year versus stocks at 10%. So yeah, I don't know. Like, I'm just all stocks. I don't hold commodities. I don't know what commodities are going to do. We have a question here. How about copper? No idea. I don't know what the price of copper is going to do. It's just same with oil stocks. Like I have no idea what oil is going to do.
Yeah,
So
well, the buzz around copper is how much the metal is used, especially in
yeah,
EV cars and stuff like that. Yeah, we're not experts here on this channel. We're not going to talk about things, as Daniel keeps saying, that we are not experts in. So unfortunately, we will not be your source of information for commodities. And we'll
I
let you know if
just
that changes. Maybe we'll get nerdy about commodities one day. I would not be surprised. But until then, definitely not something we feel comfortable going too deep on.
yeah, like I'm just not going to pretend like I know anything about this. I don't know anything about it. I've tried it before. It didn't work for me, and
Yeah, if you want to
that's
trust
about
Kevin Stone, copper is not in a good spot. So,
I just
everyone's
think
going to have their own
finding
opinion here.
I just think finding great businesses with strong cash flows that are growing is like so much easier for me than like trying to predict what commodities are going to do over the next 5 years.
Gotcha.
That's just me
Well,
though.
so far, for people just tuning in, if you go and watch the recording, we have covered Netflix earnings. We also talked about the layoffs happening at Microsoft and Google, as well as what Daniel has been buying and what I have been buying and one sell. Thank you, Mags FPS. I was going to say, Daniel, we have an hour today. I know that you are in Asia. Got about 24 minutes left. Is it time for stock talk? This is when we love to take live chats from our viewers. We really appreciate you all being here, and we do live stock analysis for you. I am not sure if you have heard of BIR, but Daniel, working great to see you.
There's a question here from Simon that says, you often compare the price to free cash flow with bonds. Could you please explain if bonds are attractive right now? I actually don't know what bonds are trading at today. Let me go check quick. I know that bonds have become more attractive over the past few years, well, over the past like 18 months. So the 10-year bond is at 3.5% right now. So it's actually come down from 4.2. In terms of if that's attractive for me, not really. Like a 3.4% return, I feel like you could get a much better return still elsewhere. But as bonds go up, like let's say, like what would happen if the 10-year government bond was yielding 15% tomorrow? Like that's a great return, and that's essentially risk-free, is assuming the US government doesn't fail. So it really, the valuation of everything in the economy, even real estate, everything depends on what interest rates and bonds are doing. Because if the government bond is 15%, then everything not yielding 15% suddenly looks like an awful investment. So that's why I compare it so much, because the bond is what it's Warren Buffett calls it the yardstick for returns and the yardstick for valuation, because it's the return you can get for taking no risk. So basically, if you're going to buy a stock, this is what the intelligent investor says. I'm going to make a video on this soon. But if you're going to buy a stock, you have to be getting more than what the bond is offering because you're taking more risk. So you have to be compensated for that risk you're taking. So on my channel, if you watch my videos, every stock I buy has to have a higher yield than a bond. If it doesn't, then you're not being compensated more for risk. You're paying a premium for risk, which doesn't make sense. So yeah, that's why I do this.
Just to be clear here, you're talking about
so
free cash flow yield, correct?
Yeah, price to free cash flow, you inverse it, you get the free cash flow yield.
Yep.
So yeah, price to free cash flow yield.
I love how we show that on like right front and center every stock on Stock Unlock. It's just so helpful.
I wish everyone just thought like that. Like once I learned that you can just inverse price ratios to get their yield, I was like, why do we even use price ratios? Why isn't everything just yield? It's like
it's really the same thing though, right? It's just like
it's the exact same
representing
thing.
As a math person, it's like for me, I don't care. I'm like, let's just pick one. But
I know, but it should be yield, because then it would be easier for every investor to start comparing, like, okay, this stock is yielding me. Like, what's easier? This stock has a 30 price to free cash flow. Now compare that to a bond. Or that stock has a 3 free cash flow yield versus a bond yield of 3.5%, which is easier to compare.
That's okay. I haven't thought about that. Is a good point, that if you are looking through the lens of comparing it to a bond, it makes it a lot easier to compare.
It's versus every investment. Like if you take an investment in real estate, you're going to be calculating it out in terms of percent. But for some reason in the stock market, it's just not that way. I don't know why.
And just to quickly define this for everyone in the chat, the total value of the business divided by the last 12 months of free cash flow it has made. So market cap divided by free cash flow trailing 12 months. That is how you get the free cash flow yield. Yeah. Any other comments you see here, Daniel? I feel bad because sometimes I'll like shout out a stock and we take a different comment, but there are a lot of great stocks in here. Maybe I'll do it again. Have you heard of BIR? I don't know. I got excited about that one, but I'm not sure if that's something we've talked about yet.
Oh, that's an oil. I think that's an oil company. I think it's a small cap oil company.
Should we do it live? It says that it has a very high stock unlock score of 4.5, and that is super high.
Sure, I'll take a look.
Yay!
Yeah, energy stocks have been having high scores. I think it's BR.TO, BIR.TO. Birchcliff Energy, yes.
Oh, this is a Canadian company? Just disclaimer, I have never looked at this stock. I'm not sure if you're familiar with it, Daniel, but 4.5 is
Yeah, so I apologize for this internet. Where this internet, my phone is giving it everything we got today. All right.
You're doing it's great. A little bit of lag, but let us know in the chat too how his quality is coming through, but it hasn't seemed to have been an issue.
Okay. Yeah. So $2 billion company. It is up 300%. I believe that this stock just 10x their dividend as well. Yeah, they did. So recently they announced an 80, that's 20 per quarter. So that's 80 cents per year dividend. Currently it's 0.88 cents per year. So they literally 10x'd their dividend.
Sorry to interrupt.
Yesterday.
Is that a free cash flow yield of 26%? Holy, wow. Well,
all right, let me
really
see.
Good stock because we were just talking about this. That is way higher than a bond. But yeah, is this business growing? Do they have a moat? Let's figure that out.
896 million. Where's that cash going though? Okay, so we need to figure out where this cash is going. So 900 million came in, and then they spent 300 million on capex, so they got 600 million left. 453 million went to paying off debt, which gives them 150 million left, which they then used to basically buy back as much stock as they could and pay 22 million in dividends. So they used more cash than came in, which is why their cash went down a bit. But does that mean the balance sheet is getting cleaned up?
Interesting. Yeah, I wonder what their tangible book is and also how much debt they have left on that balance sheet.
Well, they like to spend all their cash. Their cash is consistently very low.
Yeah, but they have the high operating cash flow though, so they have cash coming in the door, which is
that's not a problem. If you got good cash flow, that's not a problem.
Ooh,
okay, so yeah, you can see their long-term debt. So this is what the company did. All right, I love to see this. Actually, this is good management right here. So this company came into a ton of cash flow, and what they're doing with this cash flow is de-risking their business. Because just like take a look at that long-term debt. They are attacking this long-term debt. So they're really cleaning up the balance sheet. It's literally gone from 800 million to 200 million in like 18 months.
Yeah, and paying off debt like this is great to see. The number of stocks, Daniel, I see that are building debt but don't have cash flows coming in to pay it off in the future is alarming to me. So +1 for me.
Well, why this is also good is because you can see here on the cash flow statement, right, that this is a huge expense over the past year, $450 million towards debt, right? Now that their debt is low, this basically just frees up 450 million to either continue buying back stock or paying their dividend or increasing their dividend, which is exactly what the company just did yesterday. They literally 10x'd their dividend on the 19th of January yesterday. So now that the debt is
yield on that dividend.
That would be
included. Yeah,
that would be 8.9%.
Nice. Yeah, it seems like the financials have not updated yet. That is
that looks solid. That looks solid.
All right. Well, not financial advice. Obviously, I don't think that we are shareholders in this business, but in terms of a quick financial analysis, great. And if you were planning on investing, go to their investor relations website, see who their customers are, look into management, and try to gauge Are they going to grow in the future? Will they continue to be able to pay this dividend? It's looking pretty fire, honestly. I'm going to add this one to my watch list.
Yeah, it's just an oil stock, so I don't know if that cash flow is going to remain or what. I have no idea.
Yeah. Operating sector too, right? Like, is there a sector in that area of the economy going to grow or shrink? Investing is so fun.
All right, we got another question here. Daniel, how do you decide what to put in your registered account versus non-registered? So my goal is basically like, how do I reduce my taxable events in my accounts as much as possible? So if I hold dividend stocks in a non-registered account or a non-tax deferred account, then every single time I receive a dividend, I'm being taxed. So there's a taxable event. If those dividends are in tax deferred accounts, then I defer those taxable events. So basically, my taxable events go down massively if I just put dividend stocks in my TFSA and RSP. So literally every stock in those accounts pays me a dividend. So they're maxed out with dividend stocks to try and just be as tax efficient as possible.
And let me know if this is correct, Daniel, but just to reword that a bit, in terms of optimizing where you put your money, if a stock pays a dividend, it seems like you would rather put that in your, I don't know what it's called in Canada, the Roth IRA account, at least in the US, because you will get less taxes. So in terms of looking at how stocks pay you back, if they have dividends coming through, more likely to go into the account, because you could obviously save money and avoid Uncle Sam, as they'd say, paying less taxes. Not financial advice, but that sounds like a great strategy to me. I am not as smart in my Roth. I actually like to take some bets without the taxes, but an unnamed stock, because it is too small and I don't want to have any legal issues here, but there was a $17 million market cap stock I put in my Roth IRA. I am up 47% on that unrealized, which is great, but definitely a different strategy. So pick a strategy that works best for you. I take a little bit higher risk. I think Daniel's is a little bit more safe, and I might start modeling that a bit more. I've been looking at City stock, honestly. I know we're jumping around here, but someone brought that up in our Discord, trading at, they said, 40% tangible book value. A lot of other big players that own this stock that are very respectable in the investment space. So that's one that I've been looking to potentially add to my Roth IRA this year. I just need to do a lot more research on them before I would make that decision.
Yeah. Also, I just want to say that I'm a little bit more conservative in my retirement account and my tax-free savings account, because those are accounts that I plan on using for my retirement. So I really don't want to make a big mistake in them, let's just say. They're just so efficient for tax purposes that it's like, I just don't want to take too much risk in them.
Yeah, I just want to briefly address a commenter. Pedro, we do see you asking about hims and hers. I think we talked about this on a past stream, and Daniel and I just aren't super well versed in that company. So going to politely pass on that one. But we do see you, and thank you for being here.
Okay. Yeah, we've taken a look at hims before, for sure. I remember that.
I really want to pay someone to go through our lives. If anyone does this and wants a job and has a rate, let me know. But, chop up our lives and actually tag our videos so you could just search them quickly, because we have talked about so many stocks and it's definitely extremely hard to see that we've done that. So we are working on it, definitely underwater and work as always, but we will have that one day, which will be pretty awesome. Okay, I want to put it in stock unlock, honestly. Like, what stocks have we talked about? Have like the videos come up if they're tagged for a particular ticker here, and just have it very easy to get like a more engaging experience and have these questions answered.
Okay, so this is Citigroup. Let's take a look. There was $80 stock last year. They're down 38%. 14% earnings yield. PE is 7. 4% dividend. Okay. What's going on with their financials, though?
So earnings yield, because correct me if I'm wrong, earnings over free cash flow for bank stocks specifically.
Free cash flow.
14% yield.
This business is like not really growing, though. Its revenue has been like flat for 13 years. It's actually been declining since 2020, which is interesting. This is really interesting.
Interesting. I think someone was saying they were buying. We have to check this up. Buying back stocks too. I wonder what their diluted shares outstanding looks like over time.
I remember this one dropping significantly. Yeah. So since 2014, 3 million shares down to 1.96. They've repurchased a third of their shares over the past 8 years, which is good. What about their dividends? Have their dividends been growing? With a 14% earnings yield, their dividend can grow for sure. So yes, their dividend has grown. What's the compounded rate? 10% per year. Not bad.
Yeah,
The
I mean,
stock,
if they're giving value back to shareholders and buying back stocks, that's an interesting one, right? Like not growing, but giving value back to shareholders. So
yeah, and Berkshire has been buying this one too. So I don't know. I think this is probably like, if Berkshire is buying it, I think they're probably buying it as like a value investment. I don't think they're expecting it to grow. But the thing about this is when you have a 14% earnings yield, the business doesn't really need to grow. Like Citibank could return 14% to their shareholders per year based on the price today with zero growth in the future at all, right? So basically for Berkshire, then it would be like, is this earnings yield going to stay here for, the foreseeable future? And they probably think yes, but I have no idea. So I would not be buying the stock today, but I'm speculating that's what Berkshire is thinking.
yeah, it's always so. I really have a hard time just grappling with lack of growth, but like giving value back to shareholders. It's a type of investment I still have not made up my opinion on, but
Yeah, I don't really love it. They also did this with HPQ. HPQ had a 15% free cash flow yield and Berkshire was buying a lot of it. And same thing, it's like, okay, HPQ is delivering 15% to their shareholders through buybacks and dividends, but like it's not going to grow. It could grow, but it hasn't grown in years. So I don't know. Like those investments just don't really excite me personally. So I don't buy them.
okay, fair enough. I want to take another comment here from the chat.
Well, we got a few comments saying people would love to have the videos tagged.
Oh, hey Sophie, nice to see you.
Okay. I actually do have some things I want to talk about because I forgot to talk about these earlier.
Hey, let's go. And I am the time czar today, so we are at about 7-ish minutes left on this stream. We're gonna send, Daniel off to bed in Asia. But yeah, man, what's on your mind? I'm excited. That was a cliffhanger.
All right. So we were talking about Netflix earlier, right? So what I like to do in our discounted cash flow calculator is go and figure out what is the market currently pricing in, and then ask myself if I think that's too bullish or too bearish. And then if I think it's too bullish, then I don't consider the stock. If I think it's too bearish, then I start thinking about it more. So for Netflix, I went to our DCF calculator and I figured out what the market is currently pricing this stock as. So we're going to track the free cash flow over the next 10 years. And I found that for Netflix to give us a 10% annual return, which is historically what the S&P 500 has offered, it would have to trade at a 30 price to free cash flow and grow free cash flow by 23% for 10 years, which over the next decade, that would be about $12.7 billion in free cash flow, which would mean that they would need to 10x their free cash flow over the next decade.
Right. Management did give guidance that for the fiscal year of 2023, they project $3 billion of free cash flow for that entire year. I mean, not completely unrealistic if the business continues to grow. Anyways,
I think it's a lot, though. I think that's optimistic. Like,
I agree.
You have to think like, okay, so if Netflix grows at 20%, then that means, okay, the market's probably going to outperform the stock. And like when you're getting into that kind of growth rates over the next decade, it's like there's already so much optimism and perfection baked into the price that I'm like, I don't really like that. So then I did a fun experiment. and I don't have it saved on my laptop, unfortunately. So we're going to go over to TD.
Do you want to share your screen?
Am I not sharing anymore?
You were. I don't know what happened there. Yeah, you were sharing the whole thing, so we saw the DCF live
Okay.
streams. Got to roll with it.
I know I'm on my laptop. I'm getting used to it. Okay. So now, if we go over to TD Bank and we go to their earnings over the next decade, and let's say we wanted 10, we wanted 10. I'm doing the wrong thing. We want a 10 discount rate. That's the right one. This thing trades at a 12 price to earnings ratio historically. Let's say they grow earnings by 6% over the next decade per year.
What's
This
their average
means-
rate then? Oh yeah, that's below their 10%, so very realistic.
Yeah. So this would give us a compounded annual growth rate. If TD Bank can grow earnings by 6% per year over the next decade, which is actually below their historical average, then it means that the stock is selling about 11% below fair value. Now, our DCF unfortunately does not account for the dividend, but if you factor in the dividend, then this stock would actually return about 12% per year over the next decade, with only 6% earnings growth, which is less than what they have done over the past decade. So basically, like, I like stocks like this that are not pricing in that much future growth. It's not unrealistic. So yeah, I don't know. That's just kind of my thoughts on how I think about stocks sometimes.
Yeah, I agree. I think the DCF tool is really amazing for modeling future projection scenarios. And again, we always try to tie stocks back to financials. So how much free cash flow is it making? How much can that return to shareholders? Take the market cap of the company, do the ratio there, as you like to say, the yield. And it's honestly becoming one of my favorite tools in Stock Unlock. If you are not yet on it, please check us out.
We just need to get the dividends in the DCF. Like for TD, for example, we need the dividends in there. So we'll add that. Don't worry.
Yeah. Might have time for one more stock. We got a few minutes left on the stream. What are you thinking?
Do you want to pick one?
I usually just pick names I haven't heard of before. Let's see. We also really appreciate all these comments. If we are not getting to your stocks, we apologize. Let's see. Take a look at STLC or ASTL. Green Steel. Let's do it.
I feel like this is another commodity stock.
All right. We'll pass. I actually like this one. PayPal.
Yeah, sure. I haven't looked at PayPal in a while.
They flew during COVID. Their stock is way off the highs. Not that we like to measure from there. And this is one of those stocks where it's hard for me to understand their moat and where they live, because obviously we use Stripe to process payments and Stock Unlock. PayPal is a payment processor. It seems that there are just a lot of companies entering this space and their stock has been completely obliterated. So it'll be cool to do a financial analysis on it.
Okay. Well, they got a free cash flow yield of 6.5%. What is their stock down? Their stock is down 75% from the all-time high. Are they still growing?
People were screaming to buy this stock. I feel like I won't call out specifics, investment media source, when the stock went up to the hundreds, they're like, buy the stock, hold it, it's great. So I think a lot of people are down pretty heavy on this one.
Yeah, over the past 4 quarters, revenue hasn't really grown. The fourth quarter is typically the strongest quarter for this business. So when they report the fourth quarter, that'll be interesting to see how they're doing. Trailing 12 months revenue is still growing, though. Interesting.
Here's one thing I did not like about PayPal that I think hurt their brand a lot. They did have a really weird flip-flop where they claimed they were going to start charging people for spreading misinformation by what they deemed as misinformation. And everyone rightfully kind of freaked out about that, and they retracted it. So I think there's a little bit more than financials going on with this stock, which makes it interesting.
Okay, so insiders are both buying and selling. Okay. I mean, the business is still growing. It's got a 15 price to free cash flow. What is the revenue growing by, though? It is growing. Sorry, the operating cash flow is not really growing, but revenue is growing. 2% a quarter. Let's look at it in the freeform tool. Yeah, Jake, I totally agree with you, by the way. The flip flop that they did there, like, I did not like. I use PayPal, and they were going to charge people $2,500 if they thought you were spreading misinformation.
Yeah,
Like,
my whole thing with PayPal as a customer, and this is where moats come into play. I'll use it sometimes if people ask me to, but it's just so similar to other products on the
yeah,
market for sending money. So I'm just like, I would want to go look at their investor relations page and see what are they planning on building, right? Like, how are they going to keep innovating and like diversifying their product offerings to continue to bring in more revenue? Because there just seems to be more and more payment processors coming on, have like Apple and Google letting you pay more quickly as well. So, like, where's the moat with this company? I only like to invest in companies where it's very clear that they have a differentiated product offering. That hasn't been proven to me yet with PayPal.
yeah, yeah, I would agree. I really don't use PayPal that much. Their price to free cash flow is like the lowest it's been since they've been public, basically. So basically, the market is as bearish as it's ever been on PayPal. It's got a decent free cash flow yield of 6.5%. It looks like they're repurchasing a ton of stock with that free cash flow. I don't know. It's just like something about PayPal just doesn't, make me want to buy it or would make me feel great holding it. But maybe that's just me. I don't know.
The misinformation fine thing really messed with my head. But
Yeah, I
anyways,
really did not like that.
I think this is a really good place to wrap us up. I know we got to send you off to bed there in Asia. Also, for anyone tuning in, we do try to go live every week for the next few months. The timing will be choppy, but these live streams are always posted to the Stock Unlock channel. And we are, of course, 2 out of 3 founders of Stock Unlock. Head to our website, check out our software. You get a 14-day free trial. And we're dropping a portfolio tracker next week that we have been building for half a year with an internal group of subscribers. So any final words there, Daniel? What's up?
Are we releasing the portfolio tracker next week? Do you want to say that?
This is not a guarantee as an engineer because I have been, you see my eye bags, bug bashing and improving and blah, 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 blah. No promises. We are aiming for next week. If it's not out, don't come after me. It is almost ready. We're just making sure it's really buttoned up. And if you are a subscriber, I will let you into the beta testing crew and you can get access to this before it's released. So email support@stockunlock.com or hop into our Discord. Let me know and I'll add you in. So yeah, thank you everyone for being here. Really appreciate all the commenters. We were rocking at about 100 plus concurrent viewers. I know it's like literally 5 or 6 a.m. on the West Coast in the US. And it seems like we get global people tuning in. So again, thank you so much. And Daniel, keep on enjoying your trip in Asia, man. I mean, I want to see more elephant shirts. A new elephant shirt every stream.
I've already bought 2. I almost bought a 3rd one today. And then Shelby was like, Daniel, we have like another 75 days and another like 6 countries we're going to. So you should probably tone down.
Souvenirs. I love souvenirs and elephant shirts, but I don't know. I like buy me stuff. And with that, thank you everyone. I'm gonna hit this end button and no, I won't. What's up?
I just want to say we don't know for sure when the next live stream will be. As you guys have heard, there's a 12-hour time difference between me and Jake right now. It's night for me. It's morning for Jake. So just stay tuned. We'll try and keep you guys updated.
Amazing. Well, thank you everyone so much. That was a great episode 18, and we will see you at some undetermined time in the future. Take care, everyone.
Bye, everyone.